Candidates now heading to New Hampshire for next week's primaries in that state. As the race for the White House kicks into high gear, investors want to know more about these candidates' tax plans. And for that, Robert Frank joins us at the table this morning.
Good morning, Andrew. Well, one of the issues at the heart of these primaries is the wealth tax, championed by Bernie Sanders and Elizabeth Warren, but opposed by Buttigieg, Biden, and lots of other candidates. A new study, though, finds that the wealth tax could lead to a massive takeover of U.S. assets by overseas investors. So Sanders' wealth tax, of course, starts at 1% for individuals with $16 million or more, rising to 8% for individuals with $5 billion or couples with $10 billion or more. He said it would raise $4.4 trillion over 10 years. Now, the Tax Foundation finds that because overseas investors would not face a wealth tax, they would have a substantial economic advantage over Americans in buying and holding U.S. assets. So if you look at stocks, bonds, private companies, real estate, even art, they would all be effectively cheaper for overseas buyers. A wealth tax, the report says, would induce foreign inflows of hundreds of billions of dollars a year. And it says that international investors would replace homegrown billionaires as owners of capital. Now, it says a U.S. investor worth $25 million, let's say they own a bond that returns 5% a year. The effective tax rate for Americans on that would be 40%. That is, of course, before any income or capital gains tax. But a foreign buyer wouldn't pay any of that. Now, the foreign inflows would drive up the value of the dollar, and that could more than double the trade deficit. Now, there are lots of problems with the wealth tax, but this is one of those unintended consequences where you just think about that economic advantage of an overseas buyer versus a U.S. buyer.